Imagine it's a Saturday afternoon in 2026, and you're driving through the neighborhood you grew up in. The houses look smaller than you remember, the yards tighter, the paint slightly faded. This was once the symbol of making it. Two cars in the driveway, one steady job, maybe a family vacation every summer. Nothing flashy, just solid, predictable, middle class. Back then, that phrase didn't mean rich, it meant safe. It meant if you worked hard, paid your bills, and stayed out of trouble, your life would slowly improve. Now, as you scroll through real estate listings on your phone, you realize most of these homes cost more than your parents paid in their entire lifetime of mortgages. And you make more money than they ever did. That's the quiet shift nobody announces. The middle class isn't collapsing in one dramatic crash. It's thinning, stretching, fading at the edges. Not because people stopped working hard, but because the math underneath stability changed. For decades, the middle class was built on a simple formula: steady income plus manageable costs equals upward mobility. But in 2026, steady income feels less steady, and costs feel less manageable. Wages rose, yes, but housing rose faster. Healthcare expanded in complexity and price. Education turned into long-term debt instead of short-term investment. Childcare rivals rent in many cities. Groceries creep upward quietly. Insurance renewals feel like small ambushes. None of it looks catastrophic alone, but together they reshape what comfortable means. Psychologically, the middle class was never just about income, it was about predictability. It was about believing next year would be slightly better than this year. That belief created calm. It allowed families to plan, to commit, to take measured risks. But when predictability weakens, so does identity. In 2026, even people earning what used to be strong middle-class salaries feel fragile. One layoff can derail years of progress. One medical issue can destabilize savings. One economic downturn can shrink retirement accounts overnight. When your stability depends entirely on continuous performance in systems you don't control, you don't feel secure, you feel conditional. And conditional stability doesn't feel like middle class. It feels like managed risk. There's also a cultural shift happening beneath the numbers. The middle class used to be defined by ownership, a home, a car, maybe a small investment account. Ownership created leverage. Now many people rent longer, finance longer, lease instead of buy. Subscription replaces possession, debt replaces patience, access replaces equity. On paper, life looks modern and upgraded. In reality, fewer people own assets that quietly grow in the background. And without ownership, income alone can't build lasting security. Social comparison intensifies this erosion. The digital world constantly resets what normal looks like. Vacations feel standard. Renovations feel expected. Lifestyle upgrades appear effortless on screens. Even if you're rational, you absorb the signal. The cost of feeling average rises, so spending stretches slightly beyond comfort. Financing becomes normal. Debt feels manageable until it compounds. The middle class was strongest when lifestyle lagged behind income. Now, lifestyle often matches or exceeds it. That thin margin removes the buffer that once defined stability. Zoom out further and automation reshapes entire industries. Jobs that once required years of training can now be streamlined. Companies restructure faster than ever. Loyalty between employer and employee weakens. Careers feel less like ladders and more like platforms you must constantly adjust to. That instability chips away at long-term planning. When you can't confidently project your income 5 or 10 years out, you hesitate to commit deeply. That hesitation slows wealth building. The middle class was built on the assumption that time plus consistency equals growth. But when consistency feels uncertain, growth slows into maintenance. There's also a generational shift in starting points. Previous generations entered adulthood with lower housing costs relative to income and less student debt burden. Today, many start careers already leveraged. That changes the entire trajectory. Instead of building assets in their 20s, many focus on stabilizing liabilities. Compounding works best with time. When time is spent servicing debt instead of building equity, the long-term picture shifts quietly. This isn't about nostalgia, it's about structure. The economic ladder still exists, but the rungs are farther apart. The gap between those who own appreciating assets and those who rely purely on wages has widened. Asset ownership compounds, wages fluctuate, and as asset prices rise, entry barriers rise with them. So the middle narrows, not because ambition disappeared, but because leverage concentrated. The philosophical core of the middle class was always hope tied to effort. Work hard, live modestly, and over time your life expands. In 2026, effort alone feels insufficient. It must be paired with strategy, with asset acquisition, with cost control, with intentional design. Otherwise, income simply cycles through expenses without transforming into independence. That's why many people feel like they're working harder than their parents, yet feeling less secure. They are earning more in absolute terms, but capturing less in relative power. The middle class is quietly disappearing not as a dramatic fall into poverty, but as a psychological shift from confidence to caution, from ownership to obligation, from expansion to maintenance. And here's the realization that changes the narrative. The middle class was never just an income bracket, it was a margin bracket, a zone where earnings comfortably exceeded baseline needs and allowed room for building. When that margin shrinks, the class shrinks with it. The future won't be divided simply by income levels, but who owns productive assets and who rents stability month to month. The perspective shift is this: the solution isn't to chase the label of middle class, it's to rebuild margin and ownership regardless of label. Because in 2026, you're not protected by being in the middle, you're protected by how much of your life isn't dependent on your next paycheck. And once you understand that, the conversation stops being about whether the middle class is disappearing and starts being about how to design a life that doesn't disappear with it.